The title of our latest BFI Insights was Unchartered Territory, and go where no one has gone before. Now, this title might come from one of my favorite TV series, actually, but we really feel that this is a unique time, I think, in many ways. But I think that there are so many new variables now that need to be considered that it's really quite hard for investors, to figure out what they need to do next. And we believe that we're moving into a new time, and the current situation, or the current recession, and certainly also the response by governments and central banks around the world is creating a new era where I think investors need to have a long-term, game plan. So the Q3 of 2020 was a very, very, interesting quarter, because on one hand, we're still dealing with a global recession, and on the other hand, we've seen, continued recovery in equity markets. And now, a lot of people think that we're seeing a complete decoupling from financial markets from the economic reality, which we believe is true, at least to some extent. But I think investors also need to realize that the response we are seeing, globally, the response to the crisis, is additional stimulus. We're seeing additional action from central banks, and I think all these different measures in combination really lead to a situation where I think the name of the game now is whatever it takes, and whatever it takes means is that we're going to see just enormous amounts of liquidity creation, worldwide, which will I believe short term probably help to overcome some of the negative side effects of the crisis, but that will create I think enormous challenges in the long run. And again, these challenges, it's really important that investors are aware of those challenges that are coming, so that they can properly position themselves for the future. So what we've done in the report was we looked at global equity market valuations, and we were comparing European markets, Asian markets, North American markets to each other, to really kind of get a good overview of which markets are relatively expensive and which ones are relatively cheap, because we feel that in the long run it's going to be important that investors have quite a strong focus on equity investments. But where do you start, and what markets do you favor? I think the starting point is always, where do these markets stand in terms of the valuation? And the really, really interesting thing is, and a lot of investors might not fully realize that typically seems to be common sense that all markets are roughly the same, and maybe some are a little cheaper than others. But what we're actually seeing is we're seeing valuation differences in among global equity markets that have really become rather extreme. And from the point of view of an American investor, probably the most interesting comparison is the one between US equity markets and European equity markets. And there I think it's just fascinating to see that the overvaluation of US markets, or maybe you could say the undervaluation of European markets, or maybe it's a little bit of both, has never really been at this extreme for many decades. Which means US equity market is very, very expensive when you compare it to European markets. And there are a number of reasons for that. There's definitely the influence of large technology companies, which are driving part of that valuation. But it's certainly not the only reason that's driving this valuation, premium. And because we have this valuation premium in markets, this has obviously a consequence of the future returns that are expected from these markets. So if you buy into a market that is traded at very, very high levels, then the chances are that the future performance is going to be below average in the long run. So I think when investors are positioning themselves now for the next maybe 5 or 10 years, I think it's really important that they understand, where do I get the best value for my money? And maybe not only just from a valuation point of view, but also from a currency point of view. And this is where we truly feel there is a unique opportunity for an American market to, lower the exposure to US markets, get out of overvalued markets, get money out of the currently still relatively high US dollar, and use this time or this window of opportunity to allocate funds to international equities and international currency. So it's kind of, the strategy is pretty simple then. It's kind of sell high and sell high again in terms of currency, and buy into more attractively priced currencies, into more attractively priced equity markets. So I think this is, we said it a number of times in recent reports, but we truly feel this is a unique opportunity for an American investor. Yeah, I mean, as we're, moving into the fourth, quarter of this year, I think one thing that we can probably say with a high level of, certainty already is that the fourth quarter is going to be, there's going to be a lot of action. It's an action-packed fourth quarter. Not just because of the US presidential election, but certainly also because, we're going to see how, the world economy is kind of, coming back from, the deep recession we had in the last couple of months. And there is certainly, I think, reason to be cautiously optimistic. I think as we're, seeing most major economies are starting to look a little bit better again. But the presidential election is going to be the single event where basically everyone's going to focus on in the next couple of weeks. And I think what investors really need to realize, I mean, this is not so much a question of, is Trump going to be reelected, or is Biden now finally becoming the new president? Because I don't think so much that whether Biden is going to be elected or Trump is going to be there for another 4 years is making that much of a difference really in the end. Because and it kind of goes back to what I said before. This is a new era. This is a time when governments and central banks around the world just basically say, look, whatever it takes, we'll just do it. So the measures are being implemented regardless of who becomes that president in the United States. I think it'll probably have a bit of a more of a long-term impact on the political climate that we see, and international relations as a result of that. But in terms of market, we certainly expect a lot more volatility in financial markets in the coming weeks, and then eventually once the result of the election is known, probably a bit of a more of a calmer environment again. But don't forget, we can't rule out a scenario where we might actually need to wait for quite a bit of time until we actually know who is going to be the winner of the presidential election. And that would probably be the most negative scenario for financial markets, if we would be living in a situation, or maybe for weeks we don't know what the outcome is. So that is clearly a bit of a risk. But other than that, I don't think that the difference for financial markets will all be that different. And I think relatively soon after the election, investors are going to focus again on what's the global situation look like. And I think with the global situation, we clearly have now for for the first time in months, I believe, a reason to be quite hopeful for next year, because the world is already starting to slowly recovering from the pandemic, and I think eventually when there is going to be vaccine and maybe different type of medications available, then we certainly have hope that 2020 or 21 will be kind of the global comeback year. And with that, I think we would certainly see a bit more of a a positive tone for financial markets in 21, because with the improving economic outlook, we would also see a strongly improving outlook for earnings growth for companies worldwide, and we would think that that would certainly be a positive impact for equity markets. Yeah, I mean, 21 is, as I said before, I think in terms of equity markets, it certainly has the potential to be kind of a comeback year. And with the comeback year, I would think that probably a lot more capital would actually flow into equity markets eventually. So the outlook for a good 21 for equity markets, I believe is definitely there at the moment. What I think is maybe a bit of a risk for 21 is that as I said before, all the stimulus and all the additional liquidity that is being injected will probably at some time have an effect on inflation, for the future rates of inflation that we expect. And I think we would certainly also see that the whole topic of asset price inflation is going to be a very important one. But then asset price inflation means that we would most likely see increasing stock prices, increasing commodity prices, increasing precious metals prices. So I think this is already telling investors that it's going to be really, really difficult to be positioned in those asset categories that are going to benefit from this I want to say maybe somewhat forced asset price inflation in the coming years. And investors probably want to stay away from investments that are not really giving them an automatic adjustment for asset price inflation. So clearly something like the bond market would be not be a very good area to be in for the coming years. But certainly equities, precious metals, commodities, certainly as well. Those are going to be really good areas for the next 2 or 3 years. The commodity sector is an extremely interesting one at the moment, because most commodities, with the exception of precious metals, which is a little bit of a special investment case, most other commodities are trading below historical average prices, in some cases significantly below these historical averages. And the reason for that is because we've seen such a long-term decline in commodity prices over the last few years, and certainly now with the pandemic, we've seen in a number of commodities, we've seen multi-year lows in prices. And when we look ahead a little bit, what is going to happen over the next 2 to 3 years, and our, I guess, baseline scenario is still one where we think the global economy is eventually going to recover. It's not the V-shaped recovery that some had hoped for, but certainly over time the economy is starting to come back, and with it we're going to see the demand for all sorts of commodities improving again. And I think when investors are looking at commodity prices today, then most of the commodity prices are still seem to be pricing in an extremely negative scenario for the next year or two. And these are always these long-term kind of almost, I want to say, boom and bust cycles that you see in commodity prices. And clearly, these boom and bust cycles, you want to buy them when the prices are low, like we have right now, because with rising inflation expectation, with rising global economic activity, and with all sorts of especially fiscal stimulus currently being applied, we think this is creating a highly bullish investment case for all sorts of commodities. And that's why we decided to cover that in our latest report as well, and kind of in a detailed overview. We look at agricultural commodities, we look at base metals, we look at precious metals, and I really think that is something that should be very valuable for investors, so that they know how to position themselves. And clearly, in our managed strategies, our clients are going to see that already, because we're starting to include more commodity related or exposure in these portfolios. So in a way, you can say we're already starting to shift things around in such a way that we position these portfolios for 21 already with the kind of baseline scenario that I just pointed out before.